Calcutta Stock Exchange. How did a scam wipe out an old empire? In an old building in Kolkata, dust-covered screens lie silent. Once, the hopes of millions shone on these very screens, and brokers would hold their breath with every tick. Today there is no such sound there. Neither the scream of open outcry, nor the rush of the trading floor. Just one question floats in the air: can a stock exchange end like this? The fear begins right here. The place from where the heartbeat of East India's business once ran, trading has been almost silent there since 2013. And the curiosity is that can a scam, some weak rules and changing technology together make an old financial empire history? This story belongs to the Calcutta Stock Exchange. That exchange, which was once the identity of Kolkata, and which people counted among India's oldest exchanges after the Bombay Stock Exchange. The story does not start from a glass building. Its roots go into that era when Kolkata was a big commercial center of British India. It is said that around 1830 the informal trading of securities started under a neem tree. People would meet there, do deals, and the game of money ran on the strength of trust. At that time there was no app, there was no Demat account, there was no online order book. There was only voice, trust, reputation, and the fast-growing business energy of the city. Slowly, trading began to get organized. Trade increased, brokers increased, companies increased, and Kolkata's business ecosystem kept becoming bigger. Then in 1908, the formal form of the Calcutta Stock Exchange Association came forward. At that time it had around 150 members, and it was becoming not just a market but a financial institution. That place on Lyons Range slowly became the world of traders, industrialists, and brokers. Decisions here were not just about shares, but about the mood of the entire regional economy. Tea gardens, jute mills, shipping companies, coal engineering and trading businesses. In the stories of all of these, Kolkata's market was present like a silent character. In that era, Bengal's industry had its own shine. Jute mills used to run, ports remained busy, and Kolkata was considered the financial gateway of eastern India. The real strength of CSE was locality. Such investors and companies came here, to whom both the distance of Mumbai and the language of a big market felt a bit far. There was a time when local brokers knew their clients personally. Money was not just a number on a screen, it was trust connected with relationships and reputation. But the trust of the market is as fragile as it is powerful. Once trust breaks, the building can survive, but not the business model. In 1980, the Government of India gave permanent recognition to the Calcutta Stock Exchange. This strengthened its status and institutional identity. Then in 1997, CSE stepped from the old manual trading system toward the electronic screen-based C-Star system. This was a big moment of modernization. At that time, many people felt that the old exchange was getting ready for the new era. The voice of the floor was changing into screens, and speed was becoming the new language of the market. In the last years of the 1990s, the Indian stock market was changing. Liberalization, technology, private capital, and new companies were showing new dreams to investors. During this very time, NSE and BSE started becoming strong on a national scale. Technology broke the wall of geography. Now an investor, sitting even in Kolkata, could reach the national market. CSE was still relevant, but the competition had changed. Now just history was not enough. Speed, transparency, settlement safety and regulation had become equally important. In this very changing market, one name emerged: Ketan Parekh. He was not an ordinary trader. He was considered such an operator whose reach was spread to banks, brokers and selected stocks. Between 1999 and 2001, he created a heavy interest in some selected stocks. Later, in market language, these were called K10 stocks. These stocks were connected with fashionable sectors like telecom, media and technology. At that time, there was a craze for the new economy in the market, and investors saw a shining future. Ketan Parekh's method looked simple, but was dangerous. Creating buying pressure in selected shares, increasing volume, taking the price up, and creating public excitement. When volume and price are seen continuously in any stock, a retail investor thinks that perhaps something big is going to happen. This is the weakest point of market psychology. People start buying looking at the crowd, not by understanding the business. They feel that others know something which they do not know. This game got fuel from borrowed money. In reports, the name of Madhavpura Mercantile Cooperative Bank and some other banking links came up, from where funds were put into the market. When borrowed money goes into market manipulation, the risk becomes double. On one side, the stock price is artificial, on the other side, the pressure of loan repayment is real. The market believes the story as long as prices go up. As soon as the fall begins, that same leverage starts pulling the entire system down. In March 2001, the mood of the market started to change. The fall sharpened after the budget, confidence weakened, and the magic of K10 stocks began to break. Banks started looking at the value of collateral. The shares that looked powerful until yesterday were suddenly seen becoming risky paper. When lenders demand cash and borrowers do not have cash, forced selling begins. This very selling increases the panic even more. The Calcutta Stock Exchange got caught in the middle of this storm. A payment crisis emerged here, pressure came on brokers, and the weakness of the settlement system began to come forward. Rumor, fear, and loss spread together in the market. No one asks what the right price is. Everyone just searches for the exit door. For CSE, 2001 was not just a financial shock. This was a trust shock. That scandal showed that if governance is weak, old institutions too can become unsafe. The Ketan Parekh scam shook the entire Indian market. Investigations took place, regulatory action happened, and this episode became a big warning in Indian stock market history. But CSE's problem was not just a scam. The scam gave a blow, but the remaining illness was already growing from before. NSE's electronic model was fast, transparent, and national. BSE too was modernizing. Investors and companies gradually began to move toward big national exchanges. The old business model of regional exchanges slowly began to weaken. Local identity was emotional, but in the modern capital market, liquidity had become the biggest currency. Liquidity means the strong presence of buyers and sellers. Where there is liquidity, price discovery is better there, and big investors can trade comfortably. CSE's liquidity began to fall, volume started to reduce, and the attraction of active trading began to decrease. Companies too were not seeing any special benefit remaining listed there. From after 2005, its decline started looking even clearer. A big fall came in daily turnover, and market relevance slowly kept shrinking. Regulation too was becoming strict. SEBI wanted requirements like stronger compliance, better risk management, and a clearing cooperation from regional exchanges. A modern exchange is not just a trading screen. Behind it, the entire structure of surveillance, settlement guarantee, clearing system, capital adequacy, and investor protection is needed. CSE kept struggling in this new regulatory framework. The old exchange had legacy, but the demands of the new market were far more expensive and complex than that. After April 2013, trading stopped on the CSE platform. This was not a sudden death, rather it was a silence that came after a long decline. Then in 2015, SEBI started compulsory exit proceedings in the context of non-compliance and exit policy. CSE took the legal route, but the challenge was not easy. In 2024, the Calcutta High Court gave time to CSE for a clearing cooperation arrangement and regulatory compliance. Meaning, for a restart, not just the wish but infrastructure was also needed. In 2025, CSE gave a voluntary exit proposal before SEBI. This was a signal that the institution had perhaps lost the strength to come back to its old form. Here the story becomes very emotional. An exchange that once gave a platform to thousands of companies itself started waiting for the regulator's decision to save its market identity. But in 2026, suddenly this name came into the headlines again. In the West Bengal budget, the talk of CSE revival arose, and the idea of making Kolkata a financial center again came forward. The government's argument was simple. If CSE revives, it can help companies of Eastern India in fundraising. Jobs can be created, and Kolkata's old financial pride can return. To hear, this vision looks powerful. A historic institution should come back, the city's economy should get momentum, and Bengal should look strong again on the financial map. But the real question is bigger than the vision. Can a dormant regional stock exchange really compete in today's market? Today, NSE and BSE have technology, liquidity, brand trust, clearing systems, institutional participation, and massive network effects. Competing with them will not happen just through nostalgia. For revival, CSE will need regulatory approval, will need a clearing corporation or tie-up, will have to fulfill net worth norms, and will have to win back the trust of market participants. The most difficult work is trust. Technology can be bought, the building can be improved, but investor confidence returns only slowly. If companies are already comfortable on NSE and BSE, why will they come to CSE? This question is the center of the revival plan. CSE might have to think of a niche separate from traditional equity trading. Possibilities like regional SMEs, Eastern India-focused capital access, financial education or specialized products will have to be looked at. But all this will happen only when regulation allows, the business model is viable, and the exchange stands on the need of the future, not just on history. The story of the Calcutta Stock Exchange tells us that financial institutions too, like humans, fight with changing times. Those who do not adapt get left behind slowly. This story is of a scam too, but not only of a scam. This is a story of governance, liquidity, technology, regulation, and trust too. The Ketan Parekh episode gave a deep wound to CSE, but the rise of national exchanges and compliance pressure turned that wound into permanent weakness. For an investor, the biggest lesson here is that behind a shining price in the market, there is not always real value. Artificial volume, borrowed money, and hype often hide danger. If a crowd is seen in any stock, ask questions. Who bought? Why bought? What is the company's business? How much is the debt? And how far is the price from reality? For an institution, the lesson is even bigger. An old name, a grand history, and an emotional legacy cannot take the place of market discipline. To keep an exchange alive, trust, transparency, compliance, and innovation are needed. If even one of these becomes weak, the entire system can shake. For Kolkata, CSE was not just a financial platform. It was a memory of that era when the city's commercial energy gave direction to the entire eastern India. Today, the silence of Lion's Range reminds us that financial glory is not permanent. It has to be earned again in every generation. Perhaps CSE might return in a new form. Perhaps it might become history completely. But its story definitely gives a warning to the Indian market. Empires are not made overnight in the market and do not get wiped out overnight. First trust is made, then volume comes, then greed comes, then if rules are weak, collapse comes. The rise of the Calcutta Stock Exchange was a city's ambition. Its fall was a system's weakness. And its possible revival is an unanswered question even today. In the end, only this question remains. Will Kolkata be able to wear its old financial crown again, or will CSE remain just a lesson? Because money in the stock market does not run just by numbers. It runs on trust. And when trust breaks, even the oldest empire becomes just a story.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.